maybe we just can't win when it comes to calming inflation because we don't have the tools to stop it where it's most intractable. Once again, we got a consumer price index report, and it showed a cooler than expected 0.1% increase month over month instead of 0.2% number that Wall Street expected. But core inflation remains stubbornly high. We can take heart in the former, but the latter is what the Fed really cares about. There's a reason the averages started strong, but then started rolling over again. Dow ultimately finishing off 38 points. S&P declining 0.41%. NASDAQ losing 0.85%. The Fed believes it's winning a few inflation battles. Oh, but they think it's losing the war. What's driving all this persistent inflation? The biggest impact is shelters. We saw this morning's release, and I just don't know how the Fed can do much about housing with the extremely blunt instrument that is a rate hike. They've already tightened aggressively, but now longer-term rates, the ones that matter for mortgages, have come down every time they raise the short-rate Fed fund because investors assume the Fed fund boost will cause a recession. Plus, at this moment, I don't think the Fed can do much about the wage inflation number we got last Friday, a 4.2% increase year over year, slightly better than expected, but again, still high enough to give the hawks on the Fed ammunition when they argue for more rate hikes. I do think there's a better way, one that requires patience, something they seem to have run out of just when it's most needed. So what has to happen here before the Federal Reserve will stop bringing the pain?
The house of pain.
What would convince them to turn from malicious hawks into, how about tough but thoughtful barn owls? I'm losing that dove thing. First, the Fed doesn't just want to see housing inflation decelerating with smaller than expected price increases. The Fed wants your home to go down in value. They want your rent to go down. They want more homes built, more apartments built to get a little supply, because supply can indeed lower the price. But here's the unfortunate catch-22 of the situation. The Fed's sole method to bring down the cost of shelter, rate hikes, has backfired. In fact, the rate hikes at this point are boosting the price of shelter. How is that possible? Let's say you're a builder who wants to take advantage of high rents in a particular area by putting up apartments. First, you need to get a loan from a bank, right? Most of those loans are from regional banks in order to build that building. But because the Fed and Congress flooded the country with cheap money all at once during the pandemic, and the banks invested that money in longer-term bonds, safe bonds, but longer term, they're not any longer in a position to lend that money to the developer. The banks got hosed when the Fed tightened so aggressively so quickly. Typically, when banks get in trouble, it's on the credit side. It's because they made irresponsible loans, like during the run-up to the housing crisis in 2005, 6, 7. This time, the bank screwed up by buying, say, a 10-year piece of good paper, maybe Fed-backed paper, that got clobbered when short rates were pushed higher by the Fed, while longer-term bonds, as I mentioned, got crushed. Something that was somewhat unexpected, but definitely within the realm of possibility when the Fed started tightening with that kind of alacrity. We know from looking at dozens of regional banks that while they're not as concentrated as the now failed Silicon Valley Bank, many have a similar bulge in their investments in the wrong part of the curve. These banks bought longer-term bonds, and now they can't sell those bonds without realizing a huge loss. So they're under a lot of pressure to hold back on lending until things get sorted out with their depositors. Remember, if you can only have $250,000 in deposit insurance from the FDIC, you're going to move anything in excess of that to a different bank, so it's insured. Those deposit outflows are extremely worrisome to everyone, except for seemingly these people from the Federal Reserve. Yeah, only a couple of Fed officials seem to even care that these regional banks are in trouble. But if the banks aren't lending, that makes a huge difference for the Fed. They aren't paying attention. They aren't seeing what we're seeing.
They know nothing!
We're now in a situation where it'll be a lot harder to get financing to build that apartment complex. In other words, because the Fed tightened so rapidly after years of easy money, the banks are now in big trouble. And many of them will be much more reluctant to lend people or institutions money to build the apartments we need in order to make it so rents and prices of homes go down. Consequently, because of their own policies, the Fed's making it very difficult to eliminate the worst part of consumer inflation. That's right, housing. They defeated themselves by making it incredibly difficult for developers to get the money they need to build more places. It gets worse. Every time the Fed raises short rates, the longer-term rates, the ones that mortgages are priced off, they go down. And that's because bond buyers are certain that the Fed's going to cause a recession by continually raising rates so high. So the Fed's actually lowering the cost of obtaining a mortgage at this point. making it more likely that prospective buyers will bid up the price of residential property. I can't think of, for the life of me, a more counterproductive way to try to cool the housing market, which is what happens to needed to beat inflation. Every rate hike now leads to cheaper mortgages, more borrowing, and higher housing prices. Do you know that we have ruinous bidding wars all over the country? All over. The one positive here is that this will definitely be offset by the carnage at the regional banks. But my point here is that the Fed would be better off. It just did nothing, at least when it comes to the cost of shelter. All right, now let's talk about wage inflation that the Fed's so disturbed by. We've heard from four federal officials in the last week say that it pretty much doesn't matter what happens with the failed banks. They're not going to stop tightening until wage inflation comes down, because wage inflation fuels every other kind of inflation. Now, that last part is actually true. These officials, though, seem oblivious about a key concern. Until the banking crisis, there really was no reason to slow down hiring. Other than the Fed taking up short rates, really, there wasn't anything. This economy was really good. Wasn't anything that could slow down wage inflation, because there was so much money sloshing around and so much demand for workers of all kinds and so much business that needed attending. We knew this in real time from the CEO of Paychex, who came on this show and told us that. Given that Paychex processes payrolls for a huge number of small and medium-sized businesses, at that time, you had to believe things were just on fire and their numbers were gospel. Now, though, in just a few short weeks, the situation has changed entirely. Like I already explained, with the regional banks terrified of going under, they're a lot less likely to loan, and businesses are a lot less likely to borrow. So it stands to reason that if we just wait a month, maybe two, we'll see how businesses stopped, or at least slowed their hiring pretty dramatically in the wake of the Silicon Valley Bank fiasco. Business people tend to be pretty rational. They'll spend when they think it's good for them. They'll hire when they think it's good for them. They'll borrow when they think it's great. But they won't do any of that if they think things are getting bad. Instead, they'll stop hiring. They'll leave jobs open, and they will start doing what the Fed thinks they won't do. They'll be firing like mad. And listen to me, that's what's coming. It's the natural result of this mini banking crisis, and it's coming regardless of what the Fed says or does. I am telling you that our very big layoffs are looming, and you got to get ready for them. Unfortunately, the Fed seems to believe that executives have already gotten over the banking catastrophe that happened just a few weeks ago, and it's now all systems go. I couldn't disagree with these people more. And for the record, this is my first disagreement with the Fed as a whole. I have been on their side the whole darn way. Here's the bottom line. I have always felt that Jay Powell's a prudent Fed chief who's attuned to the current moment. Okay, there was that little bit in 2018 that I didn't like, but that's all right. That's way behind him. The Fed officials we've heard from lately are changing my mind about what could happen. Fortunately, it's not Powell himself saying these things. Unfortunately, I fear he agrees with the hawks who want to keep hitting us with more painful rate hikes that are no longer working and are totally unnecessary.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.